Nice to see you again.
Yeah, we're back. How are
We're
you?
back. Absolutely. So, episode three, Bob, we are talking about lifestyle versus leverage.
hmm
Can you give you credit here as well? You came up with these episode titles. Why don't you give us a little, what does this really mean?
Yeah, no, I think it's a good question. And I'm excited to be here for this episode because, in my mind, this is a choice that property management company owners need to know or need to make going into starting their company, however that start might be. Like, what is it that I want to create here? Do I want to create a job that's a lifestyle job for me? Or do I want something that I'm going to be really hard driving in, fully leveraged, focus on profits, and you might scatter some people along the way, whatever, but it's more about, hey, how can I get a property management company that's very efficient, very high profit, and that's the main driving focus versus, hey, I want a place that's great for people to work, a lifestyle business for myself, my family. So there, I think a lot of different factors that come into play here. Does that make
Yeah.
sense?
No, absolutely. And the context, I think, from my angle, right, or my perspective is I'm in the tech startup world, right?
Yeah.
And if anything, there's absolutely a difference between a lifestyle business versus a venture-backed one, right? Which
Mhm.
is arguably leveraged, right? But in the venture-backed world, it does seem like most of the time these venture-backed companies never actually hit profitability, but they can absolutely grow, right? Their sole focus is grow at all costs, grow. If you're not growing, you're dead. But if you're growing, there's always more capital you can raise. Whereas I think, interestingly, especially right now, and again, we should probably time or date these things, right? You did this last episode, but it is November 9th when we're filming
Yes.
around 1 p.m. Central, 11 a.m. Pacific. But like economy seems to be doing okay,
Hmm.
right? It's not stellar, but it's also not, we're not like,
You're
yeah,
still out on that. Yeah.
yeah, and if anything, you've got more of the small businesses where exactly your point, right? Like you can have a fantastic culture, take care of everyone, or you can focus on profit and squeeze as much as you can out of the rock or the orange or whatever analogy you want, right? And it's absolutely different how you run those businesses.
No question. And I think you brought up a good point about being venture backed. Some
Mm-hmm.
companies may have investors. And when you have investors or you're answering to a board or maybe to a group of owners, it can be a totally different scenario, right? In my
Absolutely.
case, I was fortunate to have financed it, self financed the whole thing. And I was 100% owner the entire time. So I got to make these choices. I think that's probably the case with most property management companies that are out there, but I am aware that some have other investors or people have borrowed money or have taken money from other people and they need to answer to other people besides just their own conscience.
Yeah. Bob, and I think this is feedback for ourselves, right? But episode two, I felt we did, and you mentioned this as well, we stayed pretty high level.
Mhm.
In today's episode, I'd love to go down the rabbit hole on certain topics, right?
Do that.
Even very specifically what you just said, which is like there does seem to be a new crop of property managers that have some investor backing,
Mhm.
right? What does that mean? Like, why is that different? Because most of the property managers we know, right, that have been around for ages, right? As of today, you probably are 65, and maybe if it's the sons and daughters that are listening to this podcast at this point who are like, yeah, mom and I grew up in this business. Mom and dad started the business, and here I am trying to figure out what's going to happen when they give it to me or hand me the reins. And that's a completely different environment than today. There's venture backed or private equity backed property management companies coming in. They don't have to make money. Obviously, everyone's making money, but they don't have to worry about making payroll because they have $1 million or more than $1 million sitting in the bank. They can deal with that later, right? That's a challenge, right? That's
Sure.
competition, but that's a challenge.
Absolutely. And you mentioned maybe there's $1 million in the bank. There's also probably more money where that came from if needed, if they're running out of money or perhaps not completely achieving their goals, but there's a cost to that because you're giving up ownership. So no, absolutely. I think when you're venture backed, those people are driving for growth to your point. And yeah, and when you're in that kind of company, there's going to be some roadkill. Some people jump into that. It's more of a corporate environment, I think, where people are driving for performance that's being measured and demanded by a board of directors. In this case, private equity firms are on the board, and they have expectations, and it's up to the management team to meet those expectations. And that's a whole different world than in my case. I started off as a mom and pop and grew it to a really nice business for myself and my family. And we were able to have a liquidity event at the end that was super profitable at the end, and was a great ride for 12 years. Way different than that flip side, which are the larger corporate entities that are at play out there. The Minds, the Evernest, the Pure Company, the Pure Property Management, these kind of companies that are out there now that we're competing with. I believe that there's always a place, though, especially in local markets, for the boutique, for the small business who are doing things differently and doing things a different way than those large corporations. Yeah. Are you up against maybe somebody who's better funded if you're up against a Pure or a Mind that's in your local market, but you still have complete control over how you attack that competition, versus you have to understand the people working in the local branch of those larger corporations, they're doing things the way the corporation wants them to do, and it's driven on efficiency, cost reduction, and profit. So there's plenty of room to do things differently. And maybe that helps guide this discussion, right? There might be things to do with a company that keep employees longer, that make them happier employees than maybe some of the competition. And I will tell you that it's not uncommon to hear that smaller companies are picking up clients from some of these corporate entities because the property owners, the clients, aren't happy with the way the new the new regime is managing their particular portfolio. So a lot of that going on too.
Let's dive straight into this very specifically, right? Like, I actually think some of the most common complaints that I hear from owners or clients, investors, whoever, who are essentially the owners, the landlords, right? So the clients of a management company, like the differences between an ultra large or big one versus your local small mom and pop players, there's way less individual personality, right?
Sure.
The customer service is just not there. You pick up the phone, you call. One, the bigger ones probably don't even answer, right? And two, when they do answer, it's someone that you've never met before, right? Sure. Whereas as a small mom and pop, it's typically the property manager that's going to pick up. Hopefully they pick up. Hopefully you're picking up out there, right? Pick up, no matter what, pick up, answer your text, but it's one person, right? It's two people. They're husband and wife. They can literally talk about things. Whereas in a larger one, it's maybe they're slacking or chatting at best, right? But realistically, it's probably this massive ticketing system, right? That just this person that answers today is definitely not going to be the next person who answers tomorrow, and they just lose all the context.
Yeah, I think we need to be careful to suggest that because you're a large corporation or a larger company, your customer service is going to be bad. I think it's a generalization. But to your point, if you're calling your local property management company, who's more of a boutique or a smaller organization, small business, you do know who you're going to be speaking with, and you can usually get a hold of them. Now, the larger companies we've mentioned, they're centralizing services. So you might end up talking to somebody from a bank of people who are in that centralized part of the business, whether it be accounting or customer service or leasing or maintenance. A lot of these companies are now centralizing maintenance. That's just the way it is. When I call, am I going to always get my property manager? Not always. So I think that is a big difference. And that's why I think a lot of the boutique firms or the smaller firms still have a place in this industry. No doubt about it.
Yeah. So I want to go back to, I want to make sure we touch on two of these topics. So one is how did you self-finance? I know we talked about this in episode 1, but the different types of ways to self-finance and maybe some of the milestones in which more options become available, right? Sure. But 2, you talked about the exit, right? And I think a lot of people who get into this business or maybe have been in the business never thought about an exit, right? What the options actually are. And so I want to touch on those two topics.
Let's start with the kind of funding and getting started. I think that's that. And then we could talk about the other one because it's at the other end of the story.
Yeah.
Yeah. I was fortunate in that I had a previous career in which I was in Silicon Valley in the high-tech community and working for a couple of high-tech companies that I helped take public. And so I reached a point in my life when I was in my 40s where the story about me, I jumped off the Silicon Valley treadmill, moved back to San Diego where I had 3 kids from a previous marriage, and then settled here basically because I wanted to be around them and be a part of their lives. And that's how I found my way into property management. I started buying rental properties, couldn't find a good property manager, started doing it myself, had friends approaching me, hey, will you do this for me? So happened I did have my real estate license, so I got my broker's license and started doing it as a side hustle. And then, hey, it's pretty cool. And then decided to be all in. And I had some resources to be able to self-fund that initial startup phase, during which, by the way, we talked about this, I think, in one of the other episodes, I was losing money. So you have to be, because it's just me. Yeah, I'm hustling. That's fine. But I wasn't making as much money as I was used to previously. So you have to suck that up too. And then once I started hiring people to scale and to push it and to get it to a point where it was becoming something, I was losing money. So I was fortunate to have done that. And then along the way, it got to the point where we had enough revenue that I could demonstrate to our bank, and I got a line of credit, I think for $100,000, right? Which I was using primarily only as security against making payroll. So I wanted to make sure I could make payroll on times if we had a tough month. So that's how I did it. And there were some sleepless nights along the way because I wasn't sure it was going to work, but that kind of comes with the territory. But from the very get-go, my goal with this, because I'd had this previous career, was to have something that was a lifestyle job for me. In fact, I remember at that time approached it like it was going to be a semi-retirement job. That was not the case at all.
Yeah.
No,
Let's make this very clear. You're not getting into property management to do anything related to retirement.
No, not at all. Especially when I went all in, got an office, started hiring people. Okay, then it became all absorbed. I was completely absorbed in it, and that went on for about 12 years. But yeah, I made the conscious decision at that time that, hey, I wanted a lifestyle job. I wanted a place that was a great environment, a great place to work. So I always went maybe on the big side or the more side of having a great place to work in terms of our facilities, how we furnished it, the surroundings, the equipment people had, all these things go into making a company culture. And you have to decide those things in the beginning. Are you going to be penny pinching on your facility, on how things are set? Now, I had the capital of my own to be able to put into that. Some people don't have that luxury, and they really are starting from scratch and bootstrapping things along the way. A little bit different, but you still have to make those conscious decisions about what you want it to be and have a vision for where you want it to go and what it's going to be after a certain point in time.
Yeah. I want to go to the very, very beginning for bootstrappers, right?
Okay.
Because I think in this market, we're going to have some significant tailwinds coming at us. Specifically, obviously, I think we've touched on this before, but like the vast majority of homeowners today in America are locked in at less than 5% interest rates.
Yep.
Right. And unless you're getting paid a premium for essentially that interest rate, right, that arbitrage you can do, you should absolutely turn into a landlord. But of course, nobody really wants to be a landlord and manage the properties and answer phones at 4 a.m. about the toilet not flushing. And so realistically, there's be a ton of need for property managers, right? Local property managers that want to get into it. Who are those people likely going to be? They're pretty much going to be real estate agents and brokers, right? And I think one of the things, look, it's one thing to start a management division. I think a lot of the folks that are probably pretty early may not understand where does the actual money come from, right? Outside of, obviously, look, paying rents, that's fine, right? But as a manager, you only make money when you collect rent, right? Rent does not always get paid on the first. Unlike, this is not like a subscription business or a restaurant, let's say, where if they order, they're paying, right? And even in that business, right, obviously there's credit cards, there's chargebacks and stuff like that.
That's
but
right.
like some of the fundamentals of collecting rent is if you do not collect rent, the vast majority of the time, the PM is not making any money.
True.
Right? And even if you collected rent, there's likelihoods that rent can bounce, right? And your cash flow, your livelihood is dependent on rent, right? Weirdly enough, even though you're collecting it, your livelihood also becomes dependent on rent. And then beyond that, I think a lot of people also would ask just how much do I need every month to sustain, let's say, a property management division, right? I would almost, just to put a number on it, you got to close one deal from a broker standpoint, one deal a month to support a management division, right? Without having to like worry about payroll, let's say. If you aren't at that level, I think it's going to be extremely difficult for you to start a division if you don't have at least one closing a month, that brings in a little bit of consistency from a cash flow
Are you
standpoint.
talking about closing from the real estate
Yeah,
sales?
from the real estate side, right? Because most of the
Helping
time,
fund the property management side.
exactly, the brokerage will initially fund the property management division, because the property management division, you have fixed costs. You need folks, you need staff, you need blah, blah, blah. You need the software, right? There's all this kind of stuff. Whereas worst case, when it comes to real estate transaction, you can forego all of that, use email and DocuSign, and you can get a deal done, let's say. Obviously, it's not that easy, but you need way less infrastructure when it comes to real estate transactions versus property management, right?
Well,
So,
yeah, the assumption is if you're talking about an established real estate broker who wants to start a
mhm,
property management division, I actually did it the other way around. I started my property management division.
and then became a broker.
I was a broker,
Well, yeah, you were a broker, but yeah,
but I segmented our sales division because once you have a large enough portfolio, it's a low growing fruit. Every year, so many of those properties are going to turn
are
over.
going to sell.
You want
Yeah.
to sell. And so it was like a built-in feeder system. And that was my philosophy from the get-go. But if you're already
Right.
an established broker, you already have some infrastructure in place, right? You already
Mhm.
have an email network, you already have a cloud server, you already probably have some sort of a structure set up internally, either an office or something. But there were all these things that I had to start from scratch. You might already have. And oh, by the way, this whole lawsuit now that's going on with NAR and the commission structure for realtors, things are going to shake up and you're going to have a lot more people coming and looking at property management
Yeah.
besides the slow real estate market, the high interest rates, all these things are making more people want to rent their properties. You also have this other thing that's a lingering kind of fear, uncertainty, and doubt FUD factor that's going to point other people towards being a property manager. So that's
Yeah.
kind of where we're headed.
No, absolutely. Okay. I think one other thing that you talked about, right, is in your process, you can bootstrap, right? You get to a certain point, like banks will typically not finance or provide either lines of credit or any kind of term loans until you've proven profitability for a sustained period of time.
Mm-hmm.
And unfortunately, a sustained period of time is not 2 weeks, 3 months. A lot of times they're looking for 2 years of sustained profitability to then give you about maybe 30% of your revenues for a year is usually the upper limit of what they're willing to lend or provide as a credit facility or a credit line.
Yeah, it depends upon where you go. If you walk into your branch, a lot of us now um, bank with Enterprise Bank and Trust. At the time, I was banking with Union Bank, and I remember it was the local San Diego branch up the street. And I walked in and I said, "Hey, how could we structure a credit line?" And they said, "We will loan to up to, I think it was, I want to say 75% of your top revenue line."
Okay. All right.
Okay.
That's aggressive, by the way.
It is, right. There was some factor. And by the way, I'd been a client there for quite some time, so they knew me. And in the early days, I had to personally
Oh, you have
push
the
them back.
personal guarantee, PG, everything.
Yeah,
Absolutely.
I had to PG everything, and including my initial lease for a bill for space. That went away as the company got bigger, but that was another point of leverage, right? Where you're leveraged, now you're stepping in it. And yeah, so you have some performance to make, even if it's a lifestyle business. But so that's how I did it. But you're right, like to go to an outside bank and these kind of things. Now, the availability of money was a little bit easier back then too when I did it. Then eventually I got approached by, I think it was Wells Fargo, and they offered me a credit line of credit for the business. And then I was able to pay back the local branch. So things just changed and morphed over time. But for the most part, I tried not to use those other types of credit unless I really needed to do something, like make payroll.
Yeah. There's another interesting tidbit that I've heard of, and this is in talking to the mines, the propers, the bigger kind of multi-location players.
Yeah,
They're always trying to expand. They're always trying to enter new markets.
sure.
But one of the interesting things that they use as a barometer of is there enough even here, right? Is they'll actually go to an institutional client, an existing client. And if you're a broker or whoever listening, you have clients that are maybe not institutional, but like they're buying a lot of properties,
Mm,
right? And you can go to them and look, the best form of financing is no financing, right? It's prepayments from customers. And so what these bigger players will do is they'll literally go to their clients and say, "Hey, we'll invest and open up a new market, but you have to guarantee that you're going to get to 200 units, let's say, in the next year or two."
sure.
And when you have that confidence from the demand side, then everything's a calculated risk at that point, right?
Mhm.
It's no longer guessing.
Right.
That's been a pretty interesting method of bootstrapping a management division or management company as well. And there's plenty of local players that should be able to do stuff like this, like themselves, right? Go to
Right.
your existing clients who are buying. They probably have properties managed by others, or maybe they're self-managing. And the strategy a lot of times is, look, we're not going to make any money on you or however many initial 200 units. We're just trying to establish this, right? And eventually we'll make money from others. But they're the ones who seeded and got you to that point, and it costs you no equity. It doesn't cost you any interest.
No question. And I think that was my attitude. If I can get this to the point where I'm breaking even for a while, including paying myself a nominal salary, and I wasn't making big bucks. In fact, when I started hiring employees at first, I wasn't even paying myself a salary. I was just doing it to get the business to where it could be. And I could afford, because I had other resources, I could afford to do that. But then eventually I just wanted to break even, right?
Yeah.
For a period of time so we could grow the company, scale the company, and maintain that really nice culture and a great place to work and a high level of customer service. It's interesting, the comment you made about you tapped into institutional and larger investors who have multiple properties. This is the other thing you need to think about when you're starting is, do I want to take on one or two big clients that get me to 200 doors? Or there's this big thing made about accidental landlords, right? People who have one or two different properties and they find themselves in this position. And look, there are going to be a lot of accidental landlords now, as you kicked off the episode with today, because interest rates are higher. They might be a really bad time to sell. So why not rent? The nice thing about accidental landlords is that if you have a lot of them, you're not dependent on any single one of them. And that's
absolutely.
So your risk is spread across 1 or 200 owners. That's a pretty nice position to be in, even though you have to deal with so many different personalities. You don't risk, if you upset one of your clients, that there goes a third or a half of your portfolio. And in the early stages, that was something I really thought about. And so we took on a lot of accidental landlords in the early days. That's where most of the leads were coming from, people searching the internet, finding somebody. And yeah, we had the occasional owner who had 2, 3, 4, 5 properties. Then we started targeting, okay, let's start targeting like apartment buildings. Let's find the doors so we could have volume. But we really never wanted to be a volume play. We wanted to be a high-end property management company that represented Class A properties. That's what we were about. That's how we positioned ourselves.
Yeah. What's interesting is, and maybe I'm not trying to make this a good segue, but
yeah,
I've actually seen plenty of times when, and the context here is I'm the founder at APM Help. We're like accounting and finance for small mom and pop property managers. We've been on the, let's say the buy side of acquisitions. And whenever we get essentially the breakdown of units and properties, let's say percentages of revenue for each of them, if we ever see one owner that equates to 30% or some big chunk, usually it's over 10% of your revenue, we instantly actually decrease the multiple that we're willing to pay, right, for that set of properties, essentially. Because to your point, it's like you lose one owner in that scenario, you've lost 10% of your business, right? Versus if you've got 200 units and 180 owners, right? It's essentially just by the sheer numbers, right? Every owner is less than 1% of your revenue, effectively. And so that's in that regards. Unfortunately, we are in property management, right? It is a crappy business in the sense that you're rarely going to have great Google reviews, let's say. And so you anger one owner, you make a mistake because we're all humans, right? One owner is whatever, they leave, they're not going to take 10% of your business from you. And when we talk about exits, as we shift over to this topic, like when a buyer comes in and evaluates your portfolio, your business, they're essentially looking at risk, right? What is the likelihood that what's happening today is going to continue happening? Because most of the time these buyers are levering up, they're getting financing, they need to make sure that revenue is going to continue happening. And if it doesn't, of course, they're going to get screwed themselves. So their whole job, I think, is to mitigate as much risk as possible. And one owner managing or owning 10% of your revenue, that's a big risk, right? Yeah. So let's shift over now to the exits.
Well,
right?
I want to make one other point, because
yeah, sure.
As you talked about, if you have one owner who's 10, 20, 30, you also risk getting into scenarios where the tail is wagging the dog And
Mhm.
that was the other choice, that kind of the lifestyle choice or the cultural choice that I made in the very beginning, is I really wanted to work with Class A properties and Class A owners, right? Now, sure, in the early days, we picked up some crappy properties. And typically, when you have a crappy property, that means you're going to have maybe not the greatest owner, and you might run the risk of having some bad tenants too. And it didn't take long to realize that, okay, 80% of our time is spent on 10, 20% of our properties. So that I decided right away, let's stay at the high end, stay focused. And that was, I was okay with that. I was okay to not take on certain properties because we would just pass. Like, no, we don't want to do that. A lot of properties, a lot of accidental landlords will come with tenant, we call it tenants in possession. That means they've
Mm.
fired a previous property manager. Will red flag right away. They have a tenant in place that we haven't put in, we haven't screened, and they're asking you to pick it up. Sometimes that works out, but most of the bad situations we got into were because we picked up a property with a tenant in possession. So we got really picky over the course of time. And I think that suited us well and helped us by sticking at the high end, and by high end rent rates of $3,500 and above, which is not hard to do in San Diego, really helped us in that regard. And you're dealing with usually a higher caliber owner because the properties are really nice, higher caliber, high net worth renters. And so we were actually able to maintain pretty good reviews, right? Doesn't mean we didn't have
Right.
problems, didn't mean we didn't have a couple stinkers on along the way, but that kind of helped us. So that was another conscious decision we made, lifestyle versus pushing it. I think the companies are highly leveraged, really wanting to push it. They'll take on any property, and
Yeah.
they'll deal with the fallout later. Yeah, we didn't do that. So interesting. Okay, now we can move on. Okay.
Cool. And I think what's interesting too is you were running a lifestyle business, but you pretty much got like I wouldn't say a venture exit, but you got a really fantastic exit,
Mhm.
right? Now, granted, I do think there's timing was a huge factor in that.
Yeah.
But with all things, especially like there's cycles. And so there's nothing to say you can't run a lifestyle business and then you just get lucky on it from a timing standpoint and get a levered exit effectively. And sometimes I think just stating something like right time, right place also makes a big difference. But being in that great position when you're in the right time, right place also can change everything too.
Yeah,
Right.
no question about it. Succession planning is a big part of starting any business. Starting to think about, okay, where's this going? What's the end game for me? Is there a family member who will take it over? Do I want to eventually sell? Do I want to? We haven't talked about grow. Highly leveraged companies will grow through acquisition, picking up other property management companies along the way. Where do I want this to go for myself? And so I think those are interesting topics that need to be addressed along the way. And for me, I was already on my second career, and I was getting to the point where, gosh, I would really like to step out of this mainly so that I could retire. So I started evaluating all my different options and decided to start shopping around. And that was how I did it.
And Bob, you brought your son into the
I
business,
did.
right? So I can only imagine like there one of the options was give the business to the son,
It
right? Or maybe
was.
sell the business to the son. And then of course you had a different option, a pop up or crop up. I'm sure it looked really good.
Yeah, no, we looked at all that and had a lot of conversations with my son about it. And in the end, I just wanted to make sure that when I stepped out, I could step out and not be in a situation where, okay, 10, 15 years from now, all of a sudden I'm in my 70s or something, and I'm having to step back in to fix.
Yeah, like you're still stepping in, right?
Yeah, I didn't want to be in a position to do that. And the bottom line is, even if you turn the reins over to somebody else, or you step out and you're on the board, eventually if things go bad, there's going to be a need to go back in and clean that up. So for me, maybe that was the timing thing. I felt like, hey, the timing's right for this. I'm not sure what it's going to be like 5 years from now, 10 years from now. So let's take advantage of this opportunity now.
Yeah. Bob, are you willing to actually give some numbers here, maybe some multiples on your exit?
I can't do that, but I will tell you that there are two ways of valuing a company, right?
Mm-hmm.
One is top line, and
Mm-hmm.
one is EBITDA, earnings before
EBITDA.
interest,
Yep.
taxes. In other words, your profitability.
Mhm.
Some of the suitors that are out there will look at your top line, and that's what they're wanting to base the valuation on, because the philosophy is, hey, if we absorb you into our business, we can help you become more efficient. How do the larger companies do this? They do this by kind of centralizing services. So all of a sudden, maybe your accounting cost changes. So as an operator, so they will help you do that. Others, they don't want to take on anything unless it's highly profitable already, and you get a multiple based on Your EBITDA, which could be, I don't know, sometimes 5, 6, 4 to 6, somewhere in there. Top line is probably more in the 1.5 to 2 range. That depends. So I can't talk about my valuations as a general kind of benchmark. That's what we're seeing out there.
Yeah. And I will say, because I'm in the market right now, per se, or I'm seeing deals happen, a lot of that I would say was like maybe a couple of years ago, right? If anything, now I'm actually seeing deals on an EBITDA standpoint, like 2 to 4, 4 being
Yeah.
like
Yeah.
best of breed. And
Yeah.
then from a top line multiple on revenue standpoint,
Sure.
it's like 1 at best,
Okay.
right? And now we're actually getting to fractions of 1,
Okay.
right? Mainly again, because there's no, or not to say no, but there's less upside on real estate transactions happening, right? Because a
Sure.
lot of other people also will evaluate and look at how many units do you have? Oh, you have 200. That means potentially every year you're going to 20 properties you're going to turn. That's an extra, another X amount in commissions, let's
Oh, you're
say.
talking about real estate sale transactions.
Yeah, yeah. Like you get these hybrid ones, right? Where, and
Yeah.
granted, a lot of times, at least the clients that we advise, we treat real estate commissions as zero because
Right.
there's no guarantee that they're going to happen. They're not going to happen, right? Like once a property sells, it's gone. It's no longer in your portfolio.
And I found that to be the case in terms of valuations. Now, different companies might do things differently, and of course, to your point, is things have changed since I sold maybe a couple of years ago. But most of the companies that I spoke with didn't want to value the real estate sales because it wasn't recurring. They wanted it to be based on recurring revenue. And then they had their models that they all have their different models that they would plug it into. And that's what I found to be the case.
Yeah. And remember, we're going back to what we talked about before, which
Hmm.
is real estate transactions aren't guaranteed to happen again.
That's right.
Like it's just not going to happen. Whereas leasing commissions, you can argue from a statistical standpoint, like leasing commissions will continue to happen, right?
Yeah.
Although at least a 12-month lease, it's maybe not going to 100%, like person moves out, you have to find a new one. But statistically, there's about 10% that's going to always turn every year. And you're obviously the first one who's going to get the chance to place the tenant. And so you can argue those are, it's not recurring in nature, but they're going to happen,
Yes.
right? Whereas once you sell a property, it's gone.
That's right.
Okay. One interesting thing is also who is a potential buyer, right? It's one thing to exit and have an exit strategy, but who are the potential buyers of property management companies right now?
Good question. I think that there are a lot of different prospects out there. There are individual business brokers that are just working at the local level. I know there are several of them that are well known here in San Diego, and I talk to those guys. They're typically wanting clients that they can represent, and they propose or they shop you around in the local market, hoping that someone else also in the local market wants to acquire. So that's one way to go is, okay, talk to somebody else locally. Maybe you probably know who your competition is in the area. See if you can work something out. That's interesting to turn it over to one of your area competitors. That is tough when it comes to negotiating. And from my perspective, you find you get into a more like tug of war in terms of how that might be structured. I decided to shop my company to some of the national players who are out there. And if you want me to name names, I don't know if that's what you're looking for here.
No, it's more just the general, like you've got essentially local, like literal direct competition typically, right?
Yeah.
That you may be time for you to exit. They may be just getting started and they're hungry. And then you've got more like established national or trying to become nationwide players who look at this as, ooh, that's another location, right? That's in that general area that maybe we can add on and gain efficiencies because we've got you were in La Jolla, but maybe they've got a team already in San Diego proper.
That's
right.
right. And those are, people might argue we're not a roll up if we're generalizing here, but those are typically what are known as roll ups. So you're grabbing multiple companies across the country, whatever, you're putting them together, and by doing so, you're spreading out the risk across multiple regions. If an earthquake hits San Diego, you're not completely screwed because you have properties and branches all over the country. Those are some of the things that I worried about too as an individual owner of a lifestyle business was, wow, what if something catastrophic were to hit San Diego? What if a big earthquake hit San Diego and wiped out our portfolio? Where would I be in this? And what would that? So those were some other motivating factors for me to reduce the risk, get acquired, and then step out of the organization.
Yeah, I'd love to touch on that.
Yeah, sorry. I think there's one other kind of in-betweener. There are some regional players too that are company owners who have been inspired to grow out from wherever it was where they started. So here in Southern California, there are several who are either in San Diego or up the coast in Orange County or in Riverside County who are starting the spread. You know what I'm saying?
Sure.
So
Yeah.
those can be good candidates because they're looking for property management companies to increase kind of their presence in different regional markets around them. So that's a betweener.
I think another betweener that I've actually seen quite frequently actually is it's your vendors, right? It's a plumber, not maybe not a plumber, but a general contractor that's, man, this management company sends me like $300,000 a year worth of business,
Yeah,
right? But now Bob is thinking like he's going to create an in-house maintenance team, right? I don't want that $300,000 to go away, right?
sure.
So then they actually will, they're already a general contractor, but they'll actually say that's actually lead gen for my general contractor business,
Mm.
right? So they're an interesting strategic buyer in that they'll come in, take on management, so that they essentially don't lose the revenue stream of maintenance,
That's
right? Like,
interesting. I haven't heard that, but you probably see some of that going on.
yeah, I've seen a couple. I'm not saying that that's a frequent, but I have absolutely seen essentially, and it tends to be the more maintenance side, where it's like the maintenance people are like, we're already in and out of these properties all the time, right? Like, how hard could management be? And so then they're like, oh, let's go hook up with a broker, essentially, get the license if you need to, and then they essentially do the rest of management. And I think this is also market dependent, right? If you're in like an older market, let's say in Oregon, where your homes are all built in the early 1900s, right? Like those properties or a management company there actually more looks like a maintenance company because it is constant, nonstop handyman turns, fixing leaks and things like that, because just infrastructure is just so old.
I will say too that when I was still actively involved in North County Property Group, I would get probably 2 or 3 letters a month from local businesses saying, "Hey, we want to build, we want to grow, we want to build." For the most part, I don't think that was working with companies like mine that I had, but more probably really small, like almost like broker companies that were, okay, I'm really tired of property management. I want to get it out of this.
Right.
Maybe they had 40 to 50 properties or whatever. And so not a bad way to grow. So there was a lot of that going on in the area too. I know that in the early stages of my business, there was one company in San Diego, really young guys. They got some backing from somebody and they were out acquiring businesses and they bought a bunch of companies that were struggling, distressed property management companies. And those guys were out of business within 2 years. They just didn't know
Yeah.
how to do it. They picked up all these properties, acquired, I think, 10 to 12 property management companies, and just couldn't figure it out. It
Yeah.
happened way too quickly for them. So you got to be, if you care about your people, you care about your owners, your tenants, be careful about that too. You know,
Absolutely.
I do want to say, because it just reminds me, going back to why I sold and who I sold to and all those kind of things. I really wanted, if I was going to step out, I wanted to, I was a lifestyle business. I told you this, really culture, the people were really important to me. So whatever I did, I just wanted to make sure it was good for the team too. And that it
Yep.
wasn't like a pull the ripcord and Bob bail out kind of scenario. And then, all right, everybody's on their own. I hope this works out for you. I'm out of here.
Yeah.
Did not want that. And I didn't, I just refused to enter into a relationship where I could sense that might happen. So that was another
Yeah.
big factor for me.
And I think that's a great topic, right? Because it's one thing to sell or buy a PM company,
Mm-hmm.
but operationally how you run it, right? The culture you instill. Keep in mind when you're buying an operating business, right? It's not like you get to set the culture from scratch. If anything, you're inheriting, right, staff, you're inheriting processes, you're inheriting a lot of stuff
Yeah,
and trying to figure out which hills you're willing to die on or which ones you're not, right? From a standpoint of like culture and work-life balance and all of that. Like those are lots and lots of people challenges. You may have accounting absolutely nailed down, but when you acquire 10 people effectively or inherit 10 people, like that's 10 more people that never signed up to work for you,
that's
right?
right.
Like that now are being forced to work for you. And realistically, these are all small mom and pop businesses. So if even half of those people walk away, unless you want them to walk away, but if half those people walk away, your business is not going to look the same, right? Because those 5 people probably are very important, right? So,
About it. I mean,
I
there's a
mean,
lot of risk involved for sure. So
absolutely, especially at these small levels. Another topic I wanted to touch on briefly, because a lot of people may not actually understand the business of a roll up. right? Or usually these are called private equity or PE roll-ups,
Mhm.
or PE-backed roll-ups. Is I would say, and maybe this is an uncomfortable thing for the handful of private equity folks that ever are listening, if you guys ever listen, but the name of the game is it's multiple expansion,
Sure.
right? You stack property management, you stack locations, you add more revenue, you're de-risking, exactly to Bob's point, right? If hurricane hits San Diego, because you've got 20 other locations that aren't affected by the hurricane, that's only 5% of your business, right? If all were equal, let's just say, right? Versus in Bob's case, right? He's a one owner guy or one location area. If hurricane hits San Diego, 100% of his business is gone, right?
Right.
Like, arguably, right? And so by de-risking any one location's worth of revenue, you're essentially getting paid a premium, right? You get paid more and more of a premium by lowering the risk. And so the name of the game of a private equity roll-up is literally just to expand the multiples. They
Yes.
buy low, sell high. How do you do that? You buy it, let's say 5, right? So you buy a bunch, let's say your first however many property management companies, 10 of them at 5x multiples individually, which may be decent multiples for them individually.
Right.
But then, and I was talking about an EBITDA multiple here, not a gross revenue multiple, but same kind of story. And then when you get to 50 or 100 of them, right? Those multiples without doing anything technically. And I know a lot of private equity guys are going to be like, no, we do a lot. We centralize, we consolidate HR, marketing gets better. And all. Yeah, you can talk all you want about that. But fundamentally, just by stacking all of it, your multiples just go up.
There's
Right
value in
now, you
numbers,
go to,
right? I
yeah,
mean,
there's
there's
literally just
value in numbers.
value in numbers.
No
Yeah. Now,
question
of
about it.
course,
Yeah.
if you can make it better, if you can centralize, if you can gain efficiencies across your marketing expertise, and now you've got like a small mom pop typically doesn't have a dedicated marketing person, or let's talk HR, right? Bob, did you ever have a dedicated HR admin?
No.
No, right? Because you weren't big enough to have one,
Nor
right?
did we
Like
have a dedicated legal department. You know,
exactly. And
gonna
so
dedicate, well,
as
you
you
an
get bigger and
outside,
bigger,
yeah,
yeah,
right.
you're able to start actually having these resources, right? And that looks less and less risky. And hence you go from a 5x multiple to literally the game they're playing is arbitrage, right? And there's time, there's a lot of work, don't get me wrong. I'm not discounting how hard this is, but just by doing that and adding structure, now you can sell at maybe a 7x multiple or
Right.
a 9x multiple.
Right.
Or I've seen plenty of these that go for like 16x multiples at a certain size, right?
Well, and that's one of the things that you'll find if when you're talking to potential acquisition partners who are looking at you is that, hey, leave money in the company, right? We'll
Mhm.
buy you, but leave money in the company so that you can tap into the value as we expand. And so
Right.
most people will offer that. Some are requiring it, others don't. So it just becomes one of the options at play along the way.
Yeah. No, and again, I just want to make it very clear for some folks, right? Like at the end of the day, when you're selling the business, you no longer own it.
Yeah,
And
that's right.
it's always good to have a decent understanding of what game they are playing, because guaranteed they're probably not playing the same game you were, right? So if you're
Mhm.
going to stay involved, especially if you're leaving some chips on in their stack, right? And you want that to grow, make sure you understand the game they're playing, right?
Absolutely.
Because if you don't agree with that game, just don't do it. Yeah. Okay, very good. So we've touched on essentially like advantages and disadvantages of each, right? I think one of the big things here is we're essentially saying, look, if you run a lifestyle business, you control everything, right? You control your own destiny versus joining or being a part of a leverage business or even trying to run one, right? Like a lot of times you have other people you got to answer to, right?
Yep.
Whether it's investors, whether it's growth numbers that you have to hit quarter over quarter, there's you're trading different things, and we're not saying one is better than the other. We're simply saying they're different games, and if anything, I would say don't shit on someone else's game. Just it's better just be like, oh, that's an interesting game you're playing. I'm not going to go try to play your game. I'm gonna focus on the game that I'm playing. Right.
Yeah, no question. And even if you're an independent boutique, I've never liked the word boutique. I'm using it today, but I get what it describes. It describes a smaller kind of mom and pop specialty. Maybe you're super ultra focused on a specific region, even within a county or a city. You have to take it with a grain of salt too when you go to events or to conferences and you hear other people talk about the benchmarks that are out there, or the
Right.
right NARPM published in 2020 nationwide benchmarks. And you look at some of the numbers and they can be quite shocking. You have to make sure you're looking at that through the lens of what you want your company to be. Some property management owners, property management company owners are willing to pay their people a little bit more because they want to keep a sustained and steady staff. Okay, your labor ratio may not be what others are,
Right.
but you're making that conscious decision to do that because you care about your people. You want them to stay. You want to reward and incentivize. So these are just choices that need to be made along the way, where other companies might be, nope, we're going to, hey, here's the salary. This is all we're going to pay, minimum raises each year, and don't like it, get the heck out of here. So it
Yeah.
just comes down to how you want to run your business and what you want to be as for your particular company as a property management company.
Bob, what about the level of engagement that you'd have in a business, right? Whether it's a lifestyle one versus a leveraged one.
Yeah, I think these are really good questions because in the early days, in startup days, you mentioned, hey, you're a one-man show, you've got everything going on, you're the guy up to a certain number of properties. And then you start bringing on people and having to manage those people to do things. And one of the episodes we did is, okay, how do you get to 100 doors? And is 100 doors the promised land and this kind of thing? You reach a certain point as the owner where you don't want just a job anymore. You really want to be a business owner and you want to be
Right.
working on your business, not in your business. And so for most of us, we want to get to a point where we can turn the daily reins over to someone, an operations manager who's dependable, who can trust with that. And then you become more of a CEO. Perhaps you're working at the office, perhaps you're not, versus daily being in the nitty gritty on a day in and day out basis. And this becomes another choice. Some property management company owners I speak with a lot of companies with what I'm doing now, especially as a consultant. And some people love that. They want to be involved and it's their deal. It's their baby. They don't want anything going on without them. Others are like, okay, I've got to let go of this. I know that it's time. And that's just a choice people have to make along the way.
Yeah.
But ideally, again, even if you're looking at acquisition or to be acquired, the acquiring companies are going to like the business better if they know that it can run without you.
Yeah.
You know,
Absolutely.
it's going to be more valuable than a company that hey, if this guy leaves, we're screwed because
Yeah, we're screwed. No,
yeah,
absolutely.
yeah,
So there's two topics there. One, I'd love to talk about delegating, right? Because I think as business owners, that is probably the hardest thing that people have to learn how to do or get
yeah,
really good at. But secondly, I want to talk about personal thing as well. My personal barometer of whether I was working in the business or not was being able to, one, actually take a vacation,
yeah.
but two, how many times you get roped back into the business on vacation,
Yep.
right? So I remember like first year when I was doing APM help, first vacation I did, I was still doing bank recs and cleaning books up while on vacation, right? I was taking consults. I was still in the business, but again, this was early days, right? And then by the year two, I'd hired my first director of ops. I thought I was going to be able to take that vacation. I remember telling my wife, no, it's all good. I'm director of ops now. I can step away. And no, I was still, there were fires left and right still happening all the time. And hiring a director of ops, let's say, that's great, right? But whenever a fire happens, like you're still the firefighter, like you're still the one who's called in to put it out.
Question.
Yeah. And then what was interesting for me was by year three, I again took another vacation, but that time, like outside of me, like wanting or just so you're always checking like your chats, right? Or emails, right? Like outside of me just wanting to do that, I actually was fine, right? Like I was truly able to step away and have effectively like mine or 2 week. If I'm going on true vacation, it's like a 2 weeker, go somewhere over an ocean.
Yeah.
And it actually, the business stayed alive and it was fine. I was like, oh, wow, this is what it feels like. All right. To not be working in the business constantly all the time. And it took me 3 years to truly get out.
Same with me.
Yeah. Yeah.
You know, and I think that's one of the biggest fears that I had. I did fear delegating. I really did because I felt that first of all, no one can do it as well as I can. And that was not true.
It's not
Right.
true. Yeah.
It just means that you're not trusting that other people can. Yeah, they might make mistakes, they might screw some things up, but ultimately they can do it. And the other thing is just thinking that, hey, I don't want to release this because I'm a control freak, right? I
Yeah.
don't want anybody else to, I don't want to turn this to anybody else, over to anybody else, because I'm the only one who knows how to do it. And that's wrong too, because if you think that you can do it faster yourself rather than turn it over to someone and then making sure they know how to do it, then okay, that might be good today, but it ultimately doesn't scale. You
It
have
does
to,
not scale.
right?
Yeah.
You can't scale it. Yeah, I had to delegate over the course of time. First, it was the property management aspect, then it was the accounting aspect, and then it was the marketing aspects. And then ultimately, the very last thing that I gave up was business development. And that was to my son, Brett. That was a hard one because I had the kind of institutional knowledge to be able to go out and give the pitch. And that was a really hard one to leave to somebody else. And only certain individuals can take that on. I hear all kinds of stories about these business development companies that are out there helping people bring on biz dev managers. A lot of foul balls, right? And that.
Oh yeah. You're going to be hitting a lot, and the chance of you hitting a grand slam in that kind of model tends to be almost zilch, right?
Yeah.
Maybe it's possible, but it's very rare.
Yeah. If you find the right person, my son was perfect. And then we got to the point where he grew out of it because I was further stepping out. And then we hired a business development manager. And looking back on it, he was with us a little less than a year. I figure he cost us probably about $50,000 because he didn't have the same level of enthusiasm, the same level of commitment. And I think that's the other fear about delegating as well. This person isn't going to be as committed to it as I am.
Yeah.
Anyway.
No, and I was literally just about to make the point of, as you grow as a business, right? It's almost like the function of like how much of a mistake, like how costly that mistake is that you're willing to tolerate, or what your business can actually handle.
Right.
Like early on, a $10,000 mistake can absolutely crush you. Like you can lose essentially an entire year's worth of profit, quite frankly, early on. And like recently, and this is crazy to think about this, but we've been trying website updates essentially, right? And finding website vendors and redesigning and all this stuff. I thought we found one, and we committed, we spent $12,000 on it, let's say. It turns out it wasn't the first one that was the best one. It was actually the second or third one. But it's really hard, right? Because I didn't make the decision on that. It was my chief of staff who made that decision, but I had delegated it to him, and you can't fault him for trying. But we are also at a certain size now that $12,000, I wouldn't even call it a mistake. It's just like that cost of $12,000, like we could bear the brunt of it, right? If anything, it was like, okay, that sucks, but let's move on. We found the right vendor now, and then let's go all in. But you have to be willing to like let your people also make those mistakes. That's really hard.
It's
right?
really
like,
hard.
yeah.
But I always lived under the philosophy that, look, if you don't make decisions, then you're never going to get anywhere. So I'd rather make a decision, go for it. And then if it's not working out, cut it quickly, right? I think
cut it quickly.
Don't let it go on too long. And we certainly made our share of that. There are these self-showing technologies that are out there. There are quite a few companies, and we ended up starting with someone who the technology just did not work. We committed time. We had people trained. We brought it in-house. We created like some of our signage with the phone number that was tied to this particular organization, and we had to pull the plug because it didn't work. So more than the cost associated with doing that, it was the time sink.
Oh yeah, the time, absolutely.
Lost time to implementation. So we probably wasted 3 months. Okay, whatever. At least we tried it, and then we found the one we wanted, and we were ready for it because we had already been through a bad scenario already, and then that implementation went very fast.
Yeah. Speaking of fast, there's another thing to be said about like growing at your pace, right? Or like it's one thing to grow. I think everyone wants to grow, right? But sometimes you can actually grow too quickly, right? And just what are your thoughts there? Like, how can you grow too quickly?
No, it's a really good question. You hear about companies out there, oh, we're bringing on 20, 30, 40 properties a month. I don't know how they do it, because you fold in a new property and it's pretty time consuming, right? There's a lot of heavy lifting that goes into that. So I think that is, you've heard the phrase, read the room, right? When you go into a party, you read the room. You need to read the room with your property management team and understand what they can absorb and what could potentially also bring them to the knees. You don't want this is always my philosophy. You want to bring it on, grow the company and bring on new properties at a pace that the current staff can absorb. all the time looking out into the future, maybe 6 months out to, okay, where do I need to be 6 months from now as this continues to scale, right? And then be able to bring on more doors at that time. But if you bring the team to its knees, in my opinion, then you're damaging your people, right? You're damaging relationships with the new clients you're bringing on. And I think this is, again, one of those conscientious choices that property management company owners need to make. How are they going to do this? I know a lot of companies who are like, hell, I'll take the business. I'll figure it out later. And in the meantime, they bring on 40, 50 new properties with one swipe. And it's like chaos ensues.
Yeah.
And I didn't want to do that. I just didn't. So I was more happy growing at a gradual pace, 15% per year, and just let that multiply over time. And it worked well for me. Right.
Yeah. Look, I think if you look at the market or whatever it is, like 15% year over year, you're in effectively 3 years, you're essentially doubling.
Yeah.
Every 3 years, you're doubling. Right now, obviously, if you're starting from 1, fine. In 3 years, you're at like 6.
Yeah, in the earlier
like,
years, we were growing at a pace of about 30%, and then I think it gradually, as we got that becomes harder to do as you get to 200-300 doors. Then okay, growing by 30%, that's a lot of doors.
That's 60 doors. Yeah,
right.
I mean that's 60 doors. That's 5 doors a month.
So then we kind of got at the point where we're shooting for 15% growth. So
yeah, no, absolutely. Okay. I actually want to dive a little deeper on this too, because we talked about this, I think, in episode 1, whereas it's one thing to say you want to stair step, but actually stair stepping is extremely hard, right? Because it's one thing to stair step units being added, but people don't stair step. You can't stair step people, right? And so let's use a specific example, right? Of you've got maybe 200 units. And you've got an owner that's, I've got 50 units. Can you handle it? And of course, being an enterprising growth oriented owner, you're like, absolutely, let's bring it on.
Yeah, exactly.
Right? But and you maybe you're thinking about is, oh, at 200 units, we feel really good right now, right? We're profitable. We're having extra cash flow. But then adding those 50 units all at once, like you may immediately be like, oh crap, I need another bookkeeper.
Yep.
Oh man, I need another leasing agent, or oh, I need another maintenance coordinator. And when you bring those people on, like you're probably now negative from a monthly cash flow standpoint, because you got to bring on that fixed full-time cost to do this. Arguably, if you can get away with like part-time help, fine. But like realistically, most of the time people are going to want full-time employment. So when you bring that staff on, now from 200, you're very profitable, to 250, you're negative, right? And there's chaos because you did it all at once so fast. Right? Everyone's new, there's new properties, you got to train people, right? Like maybe someone, because you hired too quickly, is not that great of a fit with your culture. And it's like, you can absolutely grow too quickly, right?
No question about it. I think this also goes to the quick conversation we had earlier about working in your business versus on your business. If you're working on your business, you're reading the room, you're seeing what your staff can absorb, you're observing how they're going about things. And this is where the stair step thing comes into play, right? If you feel like your processes are maxed out with the team you have now, what's it going to look like 3 or 4 months from now? So you have to start thinking about, hey, I've got to take some steps as the CEO to make sure that we can handle more capacity as it comes on board. All right, how are we going to do that? There are tech stacks out there to improve efficiency, right? You can train your team to do things differently. You could start looking at bringing on virtual assistants or remote employees. There's things you can start to do. So the person who's working on their business, this is another reason why delegation becomes so important, and is already looking out into the future and maybe putting things into place to handle more capacity, that company owner is going to be in a better position to take on that 50 doors, right? Versus the one who's fat, dumb, and happy and, hey, this is great, let's march along here. And they're still doing things maybe the old fashioned way. And then all of a sudden 50 doors, they're having to recreate the wheel. That's a really bad position to be in. So another sense of encouragement to, hey, for the owners out there who are listening in, start working on your business, not in your business. Get people who you can delegate to, who can do the work, and start thinking about, okay, what's life going to be like 6 months from now, a year from now?
Yeah. When a lot of this comes back to like personal tolerance, and when I say personal, I mean like the business owner's tolerance, right, for risk and stress management, and just, it's not only are you running around dealing with scattered site, we're in scattered site management, right? Like all over the place, but you're also running a business. You got to make payroll,
Yeah.
right? You deal with people problems. These are really difficult challenges that pretty much everyone that's in the business of property management it has to deal with or are faced with.
Yeah, no question. There's, and call it what you want, leverage versus lifestyle, wheeler dealer versus being conservative. I tended to be more on the conservative side. And I was always that way about my books. I was a fanatic about the books, keeping clean financials, doing things the right way, making sure we were in compliance. And there are other owners out there that, hey, I'm a wheeler. Let's do that. Let's go do that.
Yeah.
Some of the details they don't care about. They're assuming they're being taken care of. And it's just a liability waiting to happen, in my opinion.
Yeah.
But there are
Well,
those who run their businesses that way. And I'm not knocking it. It's just a different philosophy.
yeah, and I do want to caution people, right? If you're out there, I wouldn't call it wheeling and dealing, but let's say growing very rapidly, you're the owner or you're the broker, the licensed broker
Yeah,
in your business, right? It's one thing to delegate. It's another thing to, it's almost like you can trust, but you still got to verify,
that's
right?
right.
The one thing that can absolutely take you down, and I don't care if you've got 100 units or 1,000 units, if you're commingling owner money, right? So essentially taking one owner's money to pay for some other owner's toilet repair or whatever, because that owner's, I can't send you in $500 to fix it. You cannot do this kind of stuff. And similarly, you cannot do this with security deposits. And by golly, if you're staring at that security deposit bank account and you're short on payroll and you go and borrow $20,000 because you're like, oh, the management fees are going to come in next month, I'll pay it back. The second you do that, you now have a notch against you, and that is illegal. So please, like Bob had absolutely squeaky clean books. I can attest to that. Like 99% of this industry, unfortunately, does not.
Right.
Right? Do not think just because you have not been audited or you haven't gotten caught in the past, it's not going to come back to bite you in the butt. This is the one stalking horse weird thing about our industry where it is regulated in most states. And if you do it once, you're probably going to do it again, right? Because you probably didn't get caught. And just because you didn't get caught does not mean it was legal, right? Or it's okay to do. You can be pumping 20%, 30% month over month cash flow. All right. Fantastic business. But if your books are not clean, specifically the property based or trust books, that can absolutely take you down.
No
They will
question.
revoke your license, suspend it. They will shut your business down. And when I say they, I mean like your local real estate regulators, your real estate commissions, your Department of Licensing, right? Like they will revoke your license and take it all away. So
It's a really good point.
please, yeah,
Yeah. And it's one of those, it's a really good example of potentially being out of control, right? So what is your tolerance for that as a business owner? I didn't like being out of control, like not knowing what was going on and not being able to assess, where the company was in certain different areas. It drove me crazy. And not that I'm a control freak. I just wanted to know we were running a tight ship at all times. And that was more important to me than pedal to the metal, highly leveraged company growth, high profits at all costs. I just didn't want it that way. The other thing that I wanted to mention here really quickly, because we were talking about working on the business and in the business, is I get to talk to a lot of company owners, and because of what I'm doing now in my consulting business. And I've had a few recently that have come and said, gosh, the company culture just isn't what it was when I was directly involved. Okay. So they've delegated it to somebody who's running the organization, and then they've stepped away so far
yeah,
that they
taking
come
a little
back.
too many vacations.
Yeah. And they're just not involved on a daily basis. They come back and it's a different company. And it's, oh crap, what do I do now? And so it is important, even if you are trying to step away from the day to day, that you keep a finger on the pulse of what's happening within the business so that you can provide those slight course corrections when needed. And because things can drift pretty fast just in the processes, the way people do things. And so you do need to make sure you're on top of making sure that things are still going in the right direction.
Yeah. I'm going to end the podcast today or this episode by saying, just because you don't understand accounting or leasing or like fair housing or whatever it may be, if you're the business owner or the licensed broker, that liability is still yours.
That's right.
Yeah. Just because you're like, oh, the profit loss, what's that? Talk to my accountant. Just because you don't understand it doesn't mean it's not your responsibility, right? So just, yeah.
For sure. Hey, and thanks for having me today. I shared my philosophies here. I'm not suggesting that they are the correct ones, but it just the way I chose to run my business. I can adapt to helping people with how they want to do it too.
Oh
And
yeah.
they're all different styles of people, way they want to do things, the way they want to run their business, how they want to manage their employees. There's 1,000 different ways to skin a cat. So this was
Yeah.
my perspective, and it's really great talking about it today. I enjoy talking about this kind of stuff. So
No, likewise. And similarly, as a disclaimer, disclosure, right? Like I talked about specific numbers on
yeah,
certain things, right? Like we're not saying that those numbers, let's say the multiples we talked about or whatever it was, like
right.
that's what's going to happen when you hear this podcast, right? Like we're in an ever-changing economy, times are changing, interest rates change, right? And so things are absolutely going to change.
No
We're just
question.
giving you kind of context that we had when it was happening, like, when we were in it.
Yep,
So
absolutely. All right, man.
cool. Very
Good
good.
talking to you,
Thanks,
Taylor.
Bob.
All right, take
Yeah.
care.